So good morning, everyone. We'll just start the session in another 1 minute. Okay, so a very warm welcome to everyone, and thank you so much for joining this session, which is very close to our heart since it's a investor education and awareness program. My name is Manisha Pathak, and I take care of the ETF business at Mirae Asset Mutual Fund. So, today's session is more about, simplifying investing, I would say, because generally, typically, we have this thought process that investing is quite difficult. So, I'm sure anybody who is a beginner or is a seasoned investor would also be having something for themselves in this particular session. So, just to, start with the session, I would start that what is about savings. We always think that savings we have been hearing for about years from our grandparents and grandparents' time. Also, it's always a term they've been always related because we have always seen our grandmothers and mothers keeping some amount in a box of rice in the kitchen and used to keep it for savings, and that has been always being used by them for some contingencies in the family or some goals in their mind. Maybe it's the education of the child or the family, any marriage in the family. So savings has been always a very, integral part of our or conditioning of our thought process. And the same goes with, men of the family as well, because obviously savings we all know is the uh, income minus expenses is the saving. But what we have not been known for years long back was that are we kind of growing that savings, which is going to be very crucial for the coming years going forward, because as we all know that inflation is a big thing which always deteriorate the kind of wealth that we have for the savings that we keep. So savings, I would always say that every rupee that we save has something to do, and it's very important that how where that money, that rupee goes, determine how hard it works for us going forward to keep our life more comfortable. So traditionally, we've been seeing that there are majorly two ways of, investing and savings and investing. Typically, it is capital markets and the traditional investments. So whenever we talk about traditional investments, we've always been, we've been always related to, FDs and, fixed deposits or gold as a commodity. But typically, as the world evolved and the markets evolved, I think capital market has become a very important and integral part of the investments these days. Especially when we talk about capital markets, we always hear about equity, we talk about debt, and in capital markets also, like equity, we all know, right? It's like owning a piece of a company, whether whenever you buy a stock of that company, and that is also like giving a loan to somebody and getting return the interest on that. So capital market has been evolving for years now, and today as we speak we have lot many opportunities and avenues where we can invest into equity part also and debt part also. But traditionally we have always seen that largely it was always a debt portion of the traditional investments, because typically we have seen that our parents, grandparents have been investing into FDs, which is more of a debt part of that investment revenue. But capital market today, as we speak, has been evolving like like anything. And in today's world, as per your own risk appetite and the objective and goal that you have in your mind, you always have the opportunity on both equity and also debt. And it's also very imperative to understand, कि हम लोग whenever we think about always about equity, we always relate that with a lot of risk, which is which obviously that's an inherent part of equity, but knowing that risk and aligning it with your own goals and appetite and goals, I think it makes little easy to sail through that kind of risk and can you'll be able to get that kind of returns going forward in your journey of the investments. Debt, we always related to FDs, but now we have a plethora of other investments also on the debt side also, which you can choose as per your own interest and objective. So today, I think we'll be, covering a very important and very evolving concept in our session, which may give you another option to, kind of take a very, investment decision as per your goals and objectives. So, capital markets typically, we all know that mutual funds is the very common and very relatable concept that we have been seeing, because हमने इतनी ads देखी है that that mutual fund सही है. And but having said that, I think mutual funds is a kind of investment avenue which gives you the opportunity. People who are not having that kind of expertise or are the beginners, I think mutual fund is a way wherein you can start your investment journey. And you can take mutual funds like, I just to relate with an example, it's like a driver of a car who really, can choose different routes to reach, to a certain destination and, tweak his ways, which can be a active mutual fund, or maybe a driver who will always stick to a certain route and reach his destination. So I think that is called a passive investment. So just to give an analogy of both that, mutual fund maybe there are two typical ways or the investment options available. One is active and one is passive, wherein, like I mentioned, key is so active is something which is, active mutual fund is where, a expert or mutual fund manager is involved in managing the entire gamut of that or the portfolio of the scheme, and chooses his thought process, his view, and takes his investment style to create that portfolio, to create that extra alpha, or kind of give you extra return whatever the equity market is giving, or the debt market is giving. And on the other side, there's a option which is a passive mutual fund, which is, you are completely buying the index instead of a biasness of a fund manager. You're completely buying an index wherein you can get the entire piece in one click. So typically, just to give you again perspective, that active is where there is a lot of active management involved by a fund manager to create the portfolio, to generate that extra alpha. And passive is where, there are different ways by which you can completely try to replicate the index wherein you would like to, invest, or you would like to have that kind of return in your portfolio, or you want to include that particular index in your asset allocation. Interestingly, in the active side, as we today, as we speak, we have mutual funds where we have so many mutual fund across the board with thousands of schemes available from all category to large, mid, and small. On the other side, we also have passive mutual fund scheme where again we have other options to take participation. And typically, this participation in passive mutual fund, where that scheme is completely replicating the underlying index, comes with various options, like you have index available, you have ETFs available, which is exchange traded funds, or you have fund of fund, which is also called FOF. So typically, in the passive space, where you would just instead of applying a lot of analysis that which scheme to choose, you are completely aligning your goals and thought process and buying the index with these three options available into passive space. The first one, as I said, is like an index fund, and the second one is the ETFs, which is gaining a lot of momentum and obviously is also a very kind of flavor of the market and quite favorite of this new generation, especially these days. And the third option is fund of fund, where again that scheme has underlying schemes and has nothing to do with the active management in that, but certainly you're kind of buying the underlying index. So we will, maybe in the coming slides, it will be like very interesting to understand that what kind of ETFs, what is the landscape of the ETFs globally and India also, and what kind of ETFs available are there what are the benefits of, are there in the ETF to, by which, you can include that in your asset allocation, and how, what are the advantages of ETF? I think that will be quite interesting to know in our next slide as well. So before that, it's very imperative to understand, SEBI, as we all know, which is the excuse me, the Security Exchange Board of India, which is the regulator for mutual funds, has been very pro investors. They have been always thinking about the benefit of investors in various ways, and they have actually categorized, you know, different schemes into different categories. Because earlier, what used to happen, that just to give an example, that a large cap mutual fund few years back, two different large cap categories would have invested into different stocks or underlying assets. But after the SEBI regular categorization which has happened about the equity schemes, debt schemes, hybrid schemes, today it it has become very easier for the investor to compare apples to apples. Because now, if there's a large cap category, there's a certain method and criteria basis which the two large cap category would be investing into the same underlying assets with the same kind of percentage. So SEBI has actually, bifurcated different equity schemes, which is like large cap category, mid cap category, and small cap category. We all have been, hearing these words like large cap is typically the large blue chip companies of the economy, and when we speak about mid cap, these are the potential, companies which may become large cap going forward. Or we have also small cap, which are having the inherent value right now, but have a lot of potential, but with a lot of risk. So, and then also, secondly, we have some hybrid scheme, which again is a combination of equity assets and the debt assets. And in that also, we have three different categories, like you have conservative hybrid category, you have a balanced hybrid category, and also we have aggressive. So it's nothing but just the tweak between the equity and debt basis on the underlying objective of that particular hybrid category. Then you have some solution oriented products, which we will speak. And then we also have the passive category, which is like the index funds, ETF, and fund of fund. Today, like we have been discussing, and that's the topic, of course, for our discussion in our today's session. So yeah, a very important and interesting topic, which is the ETFs and which are the ever evolving opportunities. I have always been, since I take care of the ETF business, it's always very close to my heart. This topic has been always very close to my heart. So ETF, as we today speak, is not only passive; they are actually progressive. It's like something which we are talking, and today we are talking, which we always speak that it is futuristic, but ETFs today is not futuristic. Futuristic, it is the present. And for the benefit of all, and for the understanding of all, we all know what is ETF, which is the exchange traded fund. It is quite replicable and a convenient way of the investing, like you all, if people invest into stocks also in the same way. Exchange traded funds, as the name suggests, these units of the fund are traded on the exchange on real time basis and can be very conveniently bought or sell on the exchange basis on your thought process, on your inclination towards the sector theme or the broad-based strategy you would like to involve in your particular asset allocation. So, today as we speak, passive investment and active investment, just to give you a differentiation between both, like we just spoke in the other slide also. Typically, when we speak about active investment, it's typically has the potential to outperform the market. Why? Because there's a fund manager involved who has this, thought process in his mind that he has to create some alpha and beat the benchmark. Secondly, since there's a fund manager involved, it kind of exploits the market inefficiency also, and that's the reason they are able to create that extra alpha in their particular portfolio. And they also have this job of identify the factors to generate that extra alpha. Of course, we'll talk about the factors which are there in the market in my next slide. And of course, this active mutual investment comes with a fund manager risk. So when I say fund manager risk, it means the biasness. That's the human biasness that is involved in that particular active investment. On the other hand, when we talk about passive investments is about chasing the beta and not outperforming the market. So here, anybody investing into ETF or in an index fund or a fund to fund is typically, trying to chase the return of the market. And typically, they are relatively low cost for a very obvious reason because there is no fund manager per se involved to, actively churn that portfolio. So the management fee is quite relatively lower as compared to active mutual fund scheme. Hence, it is a low cost product. And when I say it's a low cost product, it's about the expense ratio when I'm talking about low cost. It's quite transparent also. Why it is transparent? Because since it is listed on the exchange, the portfolio is available, readily available on daily basis to see what does the portfolio, and there is no, negative surprises in the portfolio because that's in front of you almost daily basis. You want to, check about the portfolios. Fourth and very important for the passive, it's completely rule based. Because I mentioned, as in the active investments, there's a fund manager involved. So obviously there would be different, thought processes, change in the investment style, change in the factors involved in active side. But in a passive investment, it's completely rule based. There is no deviation. There's a certain method on which that particular, index or the portfolio is created. It is listed on the exchange and it completely rule based. Any stock coming or going out of that particular portfolio is based on the rule-based framework which is created for uh, that particular index which is listed. So these are typically different main differentiation between an active mutual fund scheme and a passive mutual fund scheme. So just to give an example, today as we speak about ETF, is just a glimpse that how anybody going into or buying an exchange traded funds kind of get the exposure. Just to give you an example, the basic example of a very broad-based index, which is a Nifty 50 index, where we get the exposure of top 50 blue chip companies. Here today, as we speak, we have this, Nifty 50 index having various, stocks with the various weightage. Anybody buying a ETF of Nifty 50 index or buying index fund or buying fund of fund will be getting the same replication of this index with the same stock, same weightage. That's the most interesting part of the passive, that you know where you're going to, kind of invest. So this is only one broad-based index, just an example to give you a glimpse of it, how a ETF or an index fund or a fund of fund gives you the exposure while you choose that particular index to take that as a part of your investment asset allocation portfolio. So, so exploring passive option as we have just had a word that, ETF, index funds and fund of funds. These are the three typical options available on the passive side. But what could be a little differentiation between these three options also? So just to give you perspective that, ETFs also replicates the benchmark. Any index fund or fund of fund also replicates the, benchmark, underlying benchmark. The difference that ETFs or the exchange traded fund is that you get the live traded on the exchange. Live stocks wherein you can see the live price of the stocks, you can buy and sell, you can do intraday trading on these stocks. The same way the units available of ETFs on the exchange is completely live. And unlike fund of fund and index fund, which are again passive, but the NAV which is allotted is of the day end NAV, like a normal mutual fund scheme. So that's the basic difference between ETF and other passive category, which is index fund and fund of fund. Third, as we said, because it's a live trading, the ETFs can be bought and sold on the exchange. Intraday trading also can be done. It can be, and the fund of fund and index funds available can be bought and sold with the AMC, since there is no demat account required. So in ETF, of course, because it's trading on the exchange, you need to have a demat account. But if you are investing into a fund of fund or index fund, you need to have a demat account as well. ETFs, again, it's a low expense ratio product. Of course, As I said, it's a passive scheme, no actively fund management is involved in that. Unlike index fund and fund of fund, where the expense ratio is little higher than the ETFs. So ETFs has a low tracking error. So when I say tracking error, that's the difference between the return of the index and the return of the underlying schemes or which is there, either it is ETF or index funds or fund of fund. So in ETFs, there's a lower tracking error. In index and fund of fund, there is a high tracking error. So typically, lower expense ratios, lower tracking error, and live trading of the exchange makes the ETF a preferred choice. Taking a passive exposure today as we speak. So again, why to use ETF in your portfolio? It's quite interesting to understand. Though we have already talked about few pointers there, but it will be interesting to know and just to reiterate that why ETF is, is a more, I would say, convenient and most favorable option to, make as a part of your passive investment is that about the trading part because it's just one click away, one button away, from your investment. It's just one click, and you can buy the entire piece of that particular index that you want to go. For example, you would like to have the top 50 blue chip companies of the Indian economy as a part of your portfolio. So instead of buying all the different, companies differently, you can just buy one Nifty 50 ETF, just to give you an example, just a click away, and you can get the entire, gamut of that 50 stocks just on one click on certain price, obviously, which is prevailing at that point in time. Then it's a very focused exposure. For example, since ETF may we have various plethora of investments. We have different opportunities available. You have broad-based index like Nifty 50, Next 50, Mid Cap 150, Small Cap. You have very focused approach ETFs also available, like you have thematic funds like maybe on ESG or manufacturing, or you have sectoral funds also available like maybe IT or financial. So it's a very passive, focused exposure. Whatever index you're trying to buy at that point in time, you know that what kind of strategy you're going to enter at that point in time. Third is that there is no fund manager risk. When I say a fund manager risk, it means the human biasness. So fund manager, of course, when they come with that expertise, but obviously that kind of expertise can go either way. So it's just that human emotion or biasness which is not involved in any passive mutual fund scheme. Fourth and very important, transparency. As I mentioned, the portfolio are available on the exchange on daily basis, which obviously does not come with negative or any other surprises. You know where your money is invested. Portfolio diversification again. Today, as I said, that instead of buying different stocks or companies in your portfolio, you're buying in one particular portfolio which is quite diversified. You have different options available. You have diversified portfolio, you have sectoral, you have thematic. So the entire asset allocation, from the asset allocation point of view, that diversification can be there. And sixth and very important, it's relatively low cost. The expense ratio, as I mentioned, are on a lower side as compared to index funds and also as compared to the active mutual fund scheme. So obviously these are the main, I would say USPs or the advantages of ETFs, which is kind of making it very popular with the investors these days. So ETF follow a rule-based, framework, and as I said, ETFs remove the risk of any personal biasness because there's a method. Basis that method, that index is created and that is listed on the exchange, and you can take a calculated, exposure or decision, wise decision to take the investment call. Uh, Fund managers' theories may not play out in time they expect. That can be one rule which, as I said, can go both ways. And there is no way a backtesting available. You can only rely on previous returns of a fund manager, wherein in a passive mutual fund scheme, for all the indexes, you have a backtested data available, which kind of gives you a little a clue about it, what kind of portfolio it is, and how the investment journey has been for that particular index for last many years. There's a very important, point which I mentioned about the ETF, that since it's trading daily on the real time on the exchange, there's a very big advantage of buying ETFs or the exchange traded funds, because we have seen there have been times, when the market opens, the market is down by about, just to give an example, about 700 points, and as an investor, obviously, you would like to enter into that market on a lower price. But and it has happened that by the market, gets over by 330, the market kind of gets recover, or it's like flat. So being an investor, if you are not investing into ETF and you're going through an index fund or a mutual fund where you're getting the closing to NAV, you would not be getting that advantage of the correction or the volatility which was there during the day. So with ETF, you can actually capture that kind of volatility, because whenever the market is down at whatever point in time during the day, you can right there, you can actually enter into that particular investment, or you can buy the ETFs and take exposure into that particular index, which cannot be, of course, done into an index fund or fund or an active mutual fund scheme. So the timing in the market, I would say, kind of when the market is volatile or it has corrected, I think ETFs gives you a very easy and convenient way to enter and to capture that particular correction in the equity market. Also, very interestingly, you would see, just to give you a landscape, how it has evolved globally, how the ETF market per se has kind of evolved globally. In 2016 till today, if you will see, the overall industry, global ETF industry size is close to $14.5 trillion. I mean, a product which used to be a niche product today at $14.5 trillion is a powerhouse. So you can see the number of ETFs listed across the world currently is close to 11,247, which is huge. Globally, if you will see, the trend is investing into ETFs. But again, because of the various and very important reasons, which is low cost, transparency, and the convenience. And that is the reason, and it's evident the kind of growth it has seen globally. Interestingly, this kind of trend has again we've been seeing in India also. So today, as we speak, where the total AUM of the ETF industry was close to 50,000 crores in 2017, today it is close to almost more than 8 lakh crores of the total AUM. So today, in last 8 years, you can see it's almost a 16x kind of growth we have seen in India, especially after COVID. And interestingly, you can see the trend that during pandemic, the kind of I would say increase we have seen in the ETF allocations into healthcare, and post pandemic we can see that trend actually shifted to IT and financials. So ETF as an investment avenue, it actually gives you a lot of opportunity to capture that trend which is going on in the industry, or in the economy. So today, as we speak, the industry size for the passive is close to all of ETF is more than 8 lakh crores of total E, which is huge, and which is actually evident at the kind of demat folios we have seen people, because it is just a one click away on your app. It's like you know, if I compare it, or if I can just give you an example, that ETF is nothing but a kind of thali. It's kind of a chef which has created a thali with different ingredients in it, and which is kind of customized and listed, and you can actually take exposure in that. And active would be something which is kind of more tailored made, and some kind of thali which is made by a different chef. So it's an analogy. I would like to say that ETF as a more convenient way and calculated way, I would say, where as an investor we know where we are investing. Very interestingly, I still remember that when people used to talk about ETF way back, people used to know only about gold ETF, because at that point in time ETFs were typically available majorly for gold at that point in time. And today, as we speak, we have seen a lot of flows into gold, silver as a commodity. But we have also seen a lot of flows coming into domestic broad-based indexes, thematic, sectoral, and smart beta also. So this obviously is evident with the growth that we have seen in the Indian economy also. And quickly just give you a perspective that what kind of ETFs are available in the industry. We have different portfolio exposure available for ETF. You have broad-based index like Nifty 50, Nifty Next 50, Midcap 150. You have sectoral funds available for technology, for financial services and ETFs, which are most focused exposure to high growth sectors. You also have thematic exposure like ESG, manufacturing and consumption, because as an investor, if you are a little evolved investor, you know what kind of wealth you can create on certain themes. I think ETF have different offerings available into emerging trends also. Then you have debt exposures available for target maturity funds. You have factor investing, which is again a very widely accepted and new, I would say, concept which is getting a lot of traction in the industry. You must have heard about momentum and alpha, which I will briefly touch upon in my next slide. You have short-term funds also available, like liquid funds available, which is kind of short-term parking. And then you have commodity as we speak, gold and silver. No other way, better way to take exposure to gold and silver commodity through the digital way of buying through ETFs. In my previous slide also talked about smart beta factor investing. So I'll just briefly touch upon that what is smart beta, just to give you a perspective. Smart beta and factor investing is something like whenever a fund manager also creates a portfolio, a mutual fund scheme maybe, whenever a portfolio is created by a fund manager, he always picks those stocks on certain factors. That factor can be alpha strategy, low volatility strategy, quality and momentum strategy. So जितने भी factors होते हैं, these value, growth and quality, typically these factor perform in different cycles. And these are called factor investing or smart beta investing. When these factors are used by an active fund manager, he creates that portfolio. When these factors are used in creating an index, that is called smart beta, because here there is no active fund manager involvement. There's a factor chosen, and basis that index is created on a methodology driven, on a rule based framework, that particular factor on that particular factor that index is created. So I would say it's a combination of both the strategies. It is active investment because there are certain factors and basis that some stocks are selected, but it is a passive scheme because it is index created and listed on the exchange. So it's a combination of both. And interestingly, these are called smart beta and factor investing also. The interesting part is that it has USPs from both the strategies, from active and passive. Hence, it is called a smart beta, where you're chasing the beta or the return of the market in a rule-based framework on certain factors. And these different factors are like we have been hearing that we have momentum and alpha strategy, which typically performs when market is in a bull run. We have a low volatility factor, which typically kind of performs a little better when market is in doldrums. The drawdowns are a little higher. So the aim of various factors is to enable generation of potentially excess return over the market. So these are different factors which are being used on the passive side also to create that extra alpha, uh, rather than just chasing the no-brainer, plain money that index. So having said that, we have been always, we've been talking a lot of advantages and USPs of ETFs, but it also comes with certain caveats, and there are certain risks associated with ETFs also, which is also very important to understand, that this is not a lower risk product, than an active equity fund. It's not that bad. It is a very convenient and one touch button way of investing into taking exposure to equity market, but it also comes with the inherent risk that equity itself has. Some categories within the smart beta can even be more riskier or more volatile also than active funds. Of course, because we know when there would be because these smart beta funds or factor investment are quite focused. placed. So there could be times when market has kind of reversed the factor. So there could be a very widely long swings also in that particular index. So it also comes with that kind of volatility, I would say. And third, people think that this does not allow you a shorter time horizon to invest into equities, because equities, whether it is through passive investment or through active investment, it has to be long term for 3 to 5 years. Even if you are investing through ETFs, the investment horizon should always be a longer horizon to get that kind of wealth that you have or objective you have in your mind. So this is all from my side. That I wanted to give you a perspective about or touch upon the advantages and USPs of ETF. I'll just open the floor for some questions if you have. I'll be happy to answer. Or maybe you can have your questions in the chat box, and I'll just maybe take that from the investors. So there's a question, what is the difference between sectoral and thematic? So typically when we speak about, sectoral funds, it means there are different sectors in the economy, right? We have financial sector, we have, IT sector in the economy. So typically when we talk about sectoral investment, it means that you're going to take exposure into that particular sector in the economy, where you have that conviction that you may make that kind of wealth, or you may feel that there's a lot of steam in that particular sector, which may kind of give you extra alpha to your portfolio. But when we talk about thematic, it is based on certain themes. Themes can be anything. It can be manufacturing theme, it can be ESG theme, which is environmental, social, and governance theme, or it can be artificial intelligence theme, it can be a defense theme. So that's the basic difference between a sectoral, which is a sector of the economy, and different sectors in the economy, or themes in the economy, which are quite evolving, or you may feel that kind of gain lot of have that kind of steam or momentum available for with that particular theme in that economy. Can liquidity be an issue or concern for ETF if we compare them to stocks, especially in Indian markets? That's a very good question, because thank you, Mr. Jagdish. That's a very good question. So I think whenever we talk about liquidity, ETF is all about liquidity. If the underlying liquidity is very comfortable, you can get the right price on the exchange. And that is the reason that almost a decade back, ETFs were not very prominent and very kind of favorite in Indian economy. But having said that, the kind of liquidity which has improved drastically in last few years has actually made ETFs more reliable and more convenient to way of investing into Indian markets also. So today, as we speak, if you talk about broad-based markets, especially like Nifty 50, Sensex 30, or IT or financials, the underlying liquidity is quite comfortable, which kind of gives that comfort to the investor that for buying and selling there is no problem, and you kind of get the right price on the exchange also. And uh, you know, uh, so typically, just for your academic interest, there are typically two types of liquidity on the exchange for ETFs. So one is by the organic liquidity, like a investor like you and me buying and selling on the exchange. And second and most important is the market maker, who gives you the liquidity on the exchange for all the ETFs. And today, across the industry, across the AMCs, there are so many market makers appointed for all the ETF schemes, which ensures that there is no liquidity issue for any of the ETFs on the exchange in Indian market also. Somebody has raised the hand. If you have a question, maybe you can just put that in the chat box. All right. Thank you, Mr. Ritesh. So maybe we can just wait for another few seconds. If anybody has any questions, I'll be happy to answer. You can, Abhya, Kumar, you can please write into the chat box in the Q&A segment. Rohan, in case you're there on the session, are you able to see any other question?
No, I think most of the questions have been answered.
Sure. So we can close the session. All
I
right.
think we have one last question from Indrani. You can address that
Mr. I cannot see the question. Just a second. Okay.
from Indrani.
Okay, so I think it's a good question. Like for ETF and the if I think if I'm getting your question right, it's about the selection of the stocks for the underlying index. So typically, just to give an example, as I mentioned that all the ETFs and indexes are rule based and selected on certain criteria. Just to give an example, if we talk about Nifty 50 ETF, which is again from top large cap 100 companies, it is the top 50 companies. It is completely selected on the market cap of those stocks. And basis that selection of 50 stocks, the weightage of these stocks again is based on the market cap. Having said that, every index has a different methodology. Typically, all the broad-based index are selected based on the market cap of the stocks. But when we go to sectoral or when we go to thematic, the criteria goes different, and the weightages of the stocks also goes different. So it depends on the in which category that ETF is basically that index is created. So for broad-based, it is typically as per the market cap. Average return expected in large and mid cap, say, to mention that as like expected return, it's quite difficult. But if you can see the last performance of the schemes, maybe it can give you certain criteria. And of course, it also depends on the kind of market conditions and the market growth and volatility of different, large and mid cap categories. So it actually ETF is completely so the return of the large and mid cap returns are completely aligned with whatever the market or the underlying index is giving in any category, whether it is large cap, mid cap, or small cap. So Rohan, I don't think we have any other questions. So maybe okay, I think there's one more question. Is it possible to invert in SIP more in ETF? Can SIP be done? And is there a combined gold and silver? Yes, of course. That's again a very good question. Gold and silver ETFs are available on the exchange. Having said that, SIP facility for these ETFs are also available. It depends on the platform where you are investing. That particular platform where from where you're investing gives you the option for doing that ISIP. It's like the stock SIP that you do. You get option for SIP as well for ETFs also. And there are products available in the industry through fund of fund where there's a combination of gold and silver also. So you can explore that if you don't want to go like in a different ways in different ETF. for gold and silver, you can take a call in gold and silver combination product also. So fund of funds are available in the industry for that as well. What can be the expense ratio of ETF funds? I understand it can be as low as 0.05. Yes, absolutely right. It completely depends on the ETF scheme that you're going. For example, 0.05% is the minimum that you get on a Nifty 50 kind of portfolio. But as you go beyond that, like from broad-based to if you go to thematic and sectoral and then to smart beta, the expense ratio is little higher, but still lower relatively as compared to active schemes. But yes, for the broad-based, these are the least. Then you have some sectoral, then you have thematic ETFs, where the kind of expense ratio a little higher as compared to the domestic one, broad-based one. So there's another question that say under ETF of large and mid cap fund investment is directly in large and mid cap equity or based on better performance of large and mid cap. So again, it's a good question. So when you are investing into an ETF of a large and mid cap category, investment is directly into large and mid cap equity stocks only. It's not based on the better performance of large and mid cap because, for example, if you are going into a large cap, which is a top 50, like Nifty 50 kind of ETF, where you will have all 50 stocks in Nifty 50 portfolio. So whenever you're buying that Nifty 50 ETF unit, you will be getting exposure to all 50 stocks, not from the selected few stocks out of 50. So it's like a more diversified and a more true to the label kind of exposure when you're going through ETF into any kind of index. I hope that answers your question. So the question that you are having, Mr. Abhay, is that how it is different from a large and mid cap fund, mutual fund. So why it is different from a actively managed large and mid cap fund is because there the fund manager will not choose, just to give an example, like I was talking about Nifty 50, a fund manager will not choose all those 50 stocks. And he will not choose those, even if he chooses that 50 stocks, he will not choose in the same weightage. Whereas if you go into an ETF, you will be getting the entire exposure to 50 stocks with the market cap weightages that it has as per the methodology of the index. So that is the typical difference between an active mutual fund of a large and mid cap category where the fund manager will choose basis on his thought process and investment style and research and analysis. He will choose the stocks and the weightage also. He may choose different factors also. He may sit on the cash. He may deploy on different times. Wherein ETF is a more simpler way where you would be, if you are taking exposure to Nifty 50, just to give an example, you will be having exposure of all 50 stocks in that one particular index with different weightages of these stocks. So that's the basic difference between a large cap and mid cap managed by a fund manager and a large and mid cap scheme of ETF scheme. Sir, I'm not sure if the mic would be available to speak about that question. Mm. Rohan, if we don't have any other question, let me know if we can
Yeah, I think we are
conclude the
done
session.
with questions. We can finish the.
Yeah. Okay. Thank you so much, everyone, for joining the session. Hope it was helpful. See you again.